Yeah. Yeah. Okay. Mhm. Okay. All right. Good evening, everybody, and welcome to the second part of the Design Your Financial Life workshop. In today's class, we are talking about investing for profits. If you go to a few housekeeping before we start. If you go to the description of this video, you are going to find a link to your workbook. So please click on the link and make a copy of your workbook. We're going to use that to work through the class. Yeah, please say hello in the chat so I can see all your chats and tell me where you're dialing in from, what part of the world you are in. But quickly make a copy of your workbook. It's also there in the chat, so you can see where it says download your workbook. I want you to click that link and make a copy of your workbook. There's also a link that says ask your questions. So please use that link. If you have any questions in the course of this workshop, use that link and post your questions in there. If you find a question that somebody already has asked that is similar to what you want to ask, give it a thumbs up. So at the end of the class, I'll go in there and answer as many questions as possible before we step out. Hi, Donna. Hi, Joshua. Hi, Joseph. Hi, Chibuzo Nelson. So glad to have you here this evening. Okay. My name is Onyeka, and I am the convener and the host of Financial Life Workshop. Like I mentioned earlier, this is investing for profits. We are going to spend at most 90 minutes on this session. I'll take about 60 minutes to walk you through investing. This class is going to be very beginner friendly. So if you're a beginner investor or an intermediate investor, then this is going to be very useful for you. And even if you have been investing for a longer period of time, I'm going to suggest that you still stick around because you might just learn something new here today. So if you have made a copy of your workbook, please say so in the chat. We're going to kick this off quickly so we don't spend longer than we need to. So at most by 7:30 West African time, we should all be out of this place. Also, if you have people who need to join, please send them a link quickly so that they can also join in. Share it on your WhatsApp status, on your social communities, to your family members, on your family chats, and tell them to join the class, okay? The workbook is freely available for everyone to download and use, and it's designed in a way that you can keep updating it in the future as often as you need to. Okay, so I'm going to start this off and share my screen. And when that is up, to tell me it's up. Welcome again, everybody. And they should be very visible at this point. Yeah, hi, Akinmuda Olusegun from South America. Thank you for joining the workshop. So this is investing for profits. The purpose of this entire workshop is to guide you through how to invest, but not just in the most conventional way where people just simply say, oh, start investing or invest 20% of your income. The goal of this workshop is to help you understand why you need to start investing and also align it with your life and the goals and the plans that you have for yourself and for your future. And why is this important? It's because financial advice can be a bit generic and you might watch 100 videos and read so many books, but if you haven't figured out how to make it apply to you as a person, then you're not really channeling your money to anything substantial that significantly impacts the quality of your life and the vision you basically have for your future. In class one of this entire workshop series, we focused a lot more on designing your financial life. And we're taking a bit of that concept and driving it into investing because at the core, investing really is about using your money to create more wealth for yourself, to meet your needs, and to basically plan your future for yourself. So what we're going to cover in this workshop, first of all, why investing matters. We're going to look at core concepts of investing, and I'm going to try to simplify that as much as possible. I'm going to show you how to start small and start smart. So whatever your income level is, you can start investing too. We're going to look at some action steps that you need to take. Well, largely you're going to decide what action steps you need to take, but I'll give you a couple of suggestions that I think you can apply towards investing better. And then I'm just going to talk to you briefly about something I have put together to support your financial journey and your goals. And then finally, we'll take the questions and answers. So basically, we can spend about 60 minutes discussing the class. 5-10 minutes interlude where I talk to you about the Smart Money Kit, and the last 20 minutes, depending on how many questions you do ask, talking about your questions and responding to those. While you're on this live call, could you please give this stream a like and please comment freely in the chat section? Like I said, I can see all your chats. And I do like classes that are very conversational. So know that you're following and you understand what we're talking about, and crack fun, have jokes, crack jokes, have fun, but don't get too distracted so you don't miss out on the most important things in this workshop. This is how to use the session. I want you to keep your workbook closed. There's a link already in the chat, so click that link and download your workbook. Keep it closed because through the class, I'm going to be prompting you on when to use your workbook, and you need to fill out a couple of information for yourself. This class, like I mentioned, is beginner to intermediate friendly. No question you have to ask is too basic. So please use the Slido link where it says ask your questions in the chat as often as you need to do. If something you just feel like, oh, how do I do this? Put it in there. I'm going to answer as many questions as possible. No question is too basic, okay? There are no stupid questions in this class. And then finally, we are going to build your plan together. And by the way, you can share with me in the comment section, what these plans that you have are. So let's get started. Who's excited? I am. All right, so why should you be investing in the first place rather than saving? And I'm going to start this by giving you just a brief story about, my life and some of the things I've done in the past. When I began earning income on my own, it was back in 2013, which is about, I guess, 12 years ago. And I used to save a lot. Like I had a crazy habit of saving. But the interesting thing about that was back then in Nigeria, a lot of my savings were about maybe 2-3% in a savings account. The thing with saving all your money is that inflation doesn't really help you. And inflation is generally the increase in price levels of goods and services. So if you think of it in the sense that what your money is able to buy today, that same amount of money won't buy that much in a month's time or in a year's time. So this is what inflation does. If you've ever gone to the grocery and realized, oh, I could spend, I'm going to be changing currencies by the way a bit in this class because they're a mixed multitude here. So if we've spent about maybe 50,000 naira typically on groceries on a monthly basis, and you did that in January, but then you come to June and you realize you're spending 80,000 naira buying the same things, but spending more money. Inflation is at work in between there, okay? So that extra money you're spending is actually coming around as a cause of inflation. So you should invest because inflation definitely eats cash. Whatever you keep in your bank is not doing you so much good. So investing is very important for that reason. And that thing is that compounding grows your money. I'm going to go a bit more into compounding at some point in this class. But what's on to keep in mind is that compounding is pretty much your money making more money of its own. So imagine your money minting money, all right? You're not actively doing something to grow the wealth, but just by virtue of putting your money in an asset that is generating returns of its own, your money is generating more money. And basically, £100 that you invest today is greater than £100 that you save today. Because when you invest £100 and you're getting, let's say, for example, 5 to 7% returns per annum, that is definitely beating the £100 you save today that is giving you 2% per annum. So investing has so much benefits for you, right? So the next thing we need to look at is your workbook. All right. So let's go to section 1 of your workbook. I know it's pretty early, but it's very important because it sets the tone for the rest of the class. I'm going to section 1 of your workbook, and I want you to fill out, write down your reasons for wanting to invest. The thing is that a lot of people simply invest for the sake of it. And so many other people simply do it because someone said, oh, you should be investing. Why aren't you investing? But there are multiple reasons why you should invest, but every single reason should tie back to what it is you want to accomplish. And your goals might be in 1 year, it could be in 3 months, 6 months, 2 years, 5 years, 10 years. It could be in the next 30 to 50 years, depending on your age, right? So there's so many reasons why people should want to invest. And so for the next 3 minutes, I'm going to give you an opportunity to write down whatever your reasons are for investing. So just fill that out in your workbook in section 1. Why do you want to invest? Your time starts now. And while you're doing that, I can tell you some of the reasons why I want to invest. For one, I want to retire well. And that's the most common reason for investing for so many people is retirement. You want to retire and still have money to sustain your quality of life when you're no longer actively earning income. And it's a fantastic reason you should be investing. But it's not the only reason you should be investing. You can invest to prepare for your children's education, even for your own education, if you still want to further your studies. You can invest to save up for your emergency fund. You can invest because you want to have some money for vacations and travels today, all right? So these are all valid reasons to invest. I'm going to give you 2 more minutes. Please, you can also feel free to share some of your reasons in the chat while you're done filling out your workbook. I'm going to give you an extra minute to wrap that up, and then we're going to move further. And when you're done, just type done and tell me one reason you've added in your workbook for wanting to invest. Hi, Catherine. Okay, so we're going to move forward now. All right. So when you think about the reason I've asked you to do this exercise, first of all, is because the goals you have is going to be the roadmap for how you actually invest. You can invest for the short term, for the medium term, for the long term, like I mentioned earlier. So it could be a 6 months event, or a 1 to 3 year event, or a 4 to 7 year event, or greater than 10-year event. So these goals will actually determine the kind of investments you put your money into. If you want to invest for the short term, but you put your money into something that is very long-term oriented, chances are that you might lose money. And if you invest money for the short term for something that is very long-term oriented, you might not maximize as much return as you're able to get simply by doing that. And so it is very important that you understand your why before you go into anything investing related. So these goals will shape your investment choices. And even as your goals change and, transform as you get older or as your life continues to progress, your investment choices will also change in the same manner. So basically, when it comes to dealing with money and investing and saving and spending, everything money related, it needs to be flexible. You're not fixing your life to align with your investments. You're adjusting your investments and everything you do with money to align with your life instead. So these are some of the common wealth goals that most people have. One is emergency fund. You need money to put aside because life happens. And when life happens, you don't want to be caught unawares. You want life to meet you prepared. That's one reason to have an emergency fund. You might want to invest for retirement. And for all of us on this group, on this call, it could be in many years to come, or it could be just around the corner. You might want to invest because you want to own a house in the future. And that's actually one of my investment goals, is to keep money for a house deposit. It might be for passive income. Beyond just what you're making from your salaries, you might be investing because you want an additional source of income that comes from a means that does not require you to actively do anything. So when you get interest payments and dividend payments, these are some of the reasons why you should invest. And it could be for your children's education, or education of any sort. It could be your own education. If you want to get an MBA today or further your education, a master's or PhD level, you can invest to meet the cost of that education plan and budget. So let's go to our workbook again. We're going to look at section 2 of our workbook this time. And here you're going to put down your investment goals. Between 1 to 3 investment goals that you have, I want you to write that down. So based on your whys for investing, put down your top 3 goals for investing. So I gave you a few examples earlier, but just pick yours. You're going to have about 2 minutes to do that. When you write your goal, in the second column, write a time frame for this goal. An example here would be, I want to invest to buy a house, and my time frame is in the next 5 years. So don't just write 5 years, by the way. What's 5 years from today? So this is 2025. 5 years from now, it's going to be 2030. So put that in 2030. If you know the month you want this to happen, put the month. Put November 2030, buy a house. It could be for retirement. I want to retire in the next 30 years or 25 years. Put that retirement and put December 20. Okay, if it's 30 years, then that should be 2055. Put December 2055 retirement in 30 years' time. It could be for education. Maybe you want to go to school in the next 1 year, then put the personal education or child education, December. It doesn't have to be December, by the way, just pick your month. This is for example's sake. It could be December 2026. So put your time frame and put your goals. And this is going to inform something you're going to do. I mentioned before that your investment goals will determine the kind of investment you put your money into. A short-term person would typically want to avoid something that is too volatile because you could lose the money before the next 1 year is up. In which case, just doing that already truncates the goal you had in mind. It becomes almost not possible to happen at the time frame you wanted. You have 1 more minute to do this. Put your investment goal, 1 more minute, and then I'm going to move forward. I can see your chat, by the way. The person who said he wanted to invest so that he's not poor, that is a good reason, but how would you define poverty? Is poverty when you own 20 million naira? Or is poverty when you own, would you know you're not poor when you have 100 million naira? Specifics, what is that for you? So it's too generic. If you can make it very specific, that would be good. So rather than poverty, it could be that you want to invest because you want to be able to afford the things that give you a good quality of life. But do you know what that number is? It's something to think about, by the way. Okay, hopefully you're done with your workbook here. All right, so let's move into what I consider to be the most important concept you need to understand when it comes to investing. And this is something that so many people do not know or do not pay attention to when it comes to investing, and it's risk. We're going to look at this in risk versus reward. So when it comes to risk and reward, a lot of people pay attention more to the reward than they pay attention to the risk. The reward is the return your investment gets you. So it could be that you invested $100 and you made an extra $50. That's the reward. But the risk is a chance that your investment might not give you the kind of reward you were looking for. You might get less. So you were expecting at the end of the year to have $150. That is your principal amount invested, your capital, plus the return it gives you, which is the $50. But instead, at the end of the year, rather than having 150, you got 50. That means your investment lost $100, or it lost $50, I'm sorry, rather than giving you an extra $50. So that is risk. And it can be flipped, by the way, too. Maybe you expected $50 more, and then it gave you $100 more too. So it could be upside, all right? But most times we think about in terms of downside risk, because we don't really want to lose money. We have loss aversion. You are going to be more excited about money gained than money lost. And if you lose money, we tend to get more fixated on what we lost than what we actually gained. And this is why risk is so important when it comes to investing, because the different investment opportunities have their various risk profiles. Some are high risk, some are medium risk, some are low risk. I'm going to explain what high to medium and low means. So basically, what I want you to understand at this point is that there is a spectrum when it comes to risk, and it goes from low to high. And each investment option falls somewhere on that scale. So when you have higher returns, chances are that the risk may be higher. And this is because the high returns are pretty much a compensation for choosing to take on more risk than the average person would be willing to. So if I told you today that if you invest your money in something, you might lose money, would you be willing to or still invest in that particular thing? Think about that. If you choose to still invest, even when you've been told that you might lose your money, then the market will basically choose to give you a bit more return for accepting to take on the risk. And so investments have risk profiles, and your reward is a compensation, a payment for your willingness to take on risk. Not everybody is comfortable with risk, and it's perfectly fine, by the way. There's nothing wrong with choosing to stay on the down low rather than risking your capital just because you want to make more money. And when your investment is low return, like you're not expecting to get so much money back just from investing in a particular asset class, then there's no giant reward for taking on zero risk or taking on lower risk. Sometimes you might get good returns in low risk investments, but generally speaking, it's not a characteristic of low risk investment, because most of them will just assure you that your capital will stay safe, even though you might not get a lot of returns in just for investing in that particular asset class. Let's talk about time. Time is another concept you need to pay attention to when it comes to investing. And this is very important because of how much you can allow your money do some work for you while you're investing. I'm trying to keep this as simple as possible without using too many big language, all right? So everybody's following still. So the most important concept when it comes to time is compound interest. I explained earlier that it's simply allowing your money make more money. But compound interest only works when you spend time in that investment. So the person who invests in, for example, the money market mutual fund and does this for only 3 months will not make as much money as a person who invests in the same money market mutual fund but does it for 2 years. In the 2-year period, there is more time spent in that investment. There is more money being fed into it. And if person B, who invests for 2 years, is reinvesting their interest, they will make more money in 2 years than person A, who does it for only 3 months. And this is why time is so important for compound interest to work. And so when it comes to investing, if you want to maximize your returns or the rewards you get from investing, always think about giving it time. It's the same for investments that have so much ups and downs. That's volatility, by the way. If you give time in that investment, over a period of time, that volatility that is this way will even out. But if you stay in for only a short period of time, you might get out when it's high, but then you might also get out when it's low. But the person who stays for longer will outperform the person who stays in that space for just a short period of time. So time is so important than timing. When people ask questions like, and by the way, if you are one of these people, you do need to stop, who says things like, oh, is it a good time to buy this stock? Where should I buy? At what price should I buy? Maybe I'll go in when it's low, or maybe I'll step out when it's high. You're not doing yourself a lot of favor unless you're trading. But if your goal is to invest for a long period of time, then jumping in and out doesn't serve you as much as the person who just stays in and rides the wave for 10, 20, 30 years. Something else to think about time is time versus skill. I told you about time versus timing. Now let's look at time versus skill. And we're going to use the example of two very, very popular men when it comes to the stock market. One is Warren Buffett and the other is James Simmons. This scenario is at least about 5 years old, by the way. So their net worth is definitely more than this today. But Warren Buffett began to invest when he was just a teenager. And he's done this for so many years. And if you can see, his average rate of return in the stock market is about 22%. James Simmons' average rate of return is over 66% per year. Now, when you think about 22% versus 66%, you would expect James Simmons to do better in the long run, right? But he's not doing better. Actually, Warren Buffett, who is only 22%, is doing better. And the reason is time. Warren Buffett has been in the market a lot longer than James Simmons are. Warren Buffett started in his teenage years to invest. James Simmons started, he didn't hit his stride, he hit his 50s. So because Warren has spent longer, it didn't matter that he was getting lower returns than Jim. His net worth about 5 years ago was over $100 billion. But Jim, who started late, has a net worth of about 22 billion. So it's not so much about how much skill you have when it comes to investing or how perfect you are at reading the market or reading the charts or knowing how to beat the market or how to get better rewards than the average person. Time is such an important concept because it gives you better in the long run. Over a longer period of time, you get more than the person who starts late. And this, by the way, not so that if you're just starting late, it's not a bad thing. You're still better than the person who's going to start 5 years from today. So please don't feel discouraged, right? So now let's go to the next section of our workbook, section 3. You're going to define your risk comfort. There are 3 check boxes there. So just respond first of all to how you feel about risk, how you think you feel about risk. Then when you've done that, I want you to click the link below it. It is a risk questionnaire. It has about, I think, 5 questions, and I want you to fill that. So respond to the question. You have about 3 minutes to do this, okay? Respond to the questions, and then just take note of what response it gives, what answer you get at the end. So if you get the answer at the end, you can just copy it and paste it in your workbook just below the link. So 3 minutes, you can start now. And feel free to also share in the chat what you have as your final result when you've taken the quiz. 3 minutes, your time starts now. Hi, Kayode, watching from Dublin. Welcome. Your workbook is pinned to the top of the chat, so please grab yours there and follow along. You have about 2 more minutes to do this. And try to respond to the questions, by the way, as honestly as you can, because your honesty really matters in determining your risk profile. Don't respond what you think you want to be, but respond how you actually feel today. It's possible that sometime in the future, you might be more prone to taking on more risk in investment, but this is not the future. This is today. So respond in terms of how I am now, not how I would want to be. This matters so much, okay? Less than 2 minutes to go. Actually, 1 minute to go. I'm not sure why the website is telling you blocked, but I actually do have access to it. Is it your location? It might be your location though. But if you do have access, please respond to the questionnaire. All right, one more minute to go, and then we're going forward. It's okay to be risk averse, nothing wrong with that. So when it comes to investing, taking on more risk is pretty much a muscle you need to build over time. So one suggestion could be start with investments that are very low risk. And then as you do more of that, begin to give a little percentage of your investment to some high risk. Because the thing is, if you are highly focused on low risk investments, you're not going to get as much, you're not going to maximize as much return as you can from the markets. So even if you can start with doing maybe 100% low risk, and then you gradually do 95% low risk and give 5% to high risk and see how you feel about it. All right. And then, just gradually adjust that way. But please don't ever go 100% high risk. That's not very good diversification or asset allocation management. And it's not very good risk management, by the way. So start small and then build up your risk tolerance over time. But don't feel the need to jump into something high risk just because everybody says it's what everyone is doing now. Dima says 34 points. You're not afraid to risk a little, but you don't take risk unnecessarily. That's a very amazing result. Thank you for sharing that. Okay, so let's look at investment basic, which is, I'm sure, the reason why some of you are on this call today. We're going to be focusing on stocks, bonds, ETFs, index funds, and mutual funds. Why? Because these are more readily and easily available to pretty much everybody, irrespective of the country where you're coming from. So in short, stocks is ownership. When you buy the stocks of a company, you are basically becoming a part owner of that company. And that's how I want to think about stock investing going forward. When I buy shares from Apple, I'm a co-owner of Apple. When you buy the shares of Coca-Cola, you're a co-owner of Coca-Cola. That's what shares is. So every time a company is saying, come buy some shares, they're saying they need money to run operations because these companies do not just function without money. And for choosing to give them some of your money to run operations, they give you a portion of the company as your own too. But then there are directors and management who run the company to make money. So stocks is to own. Bonds is to lend. So when a company or a government offers bonds, they are borrowing money from you. So rather than owning a part of the company or owning a part of the government, I guess, what you're doing is lending them your money to use for their operations or their projects. And then they will pay you back your principal amount you loaned them plus some interest to basically say, well, thank you for giving us some of this money. Now, there are two different types of bonds specifically. There is the government bond and there's the corporate bond. So the government bond is lending money to the government. The corporate bond is lending money to companies. And then when it comes to ETFs, index funds, and mutual funds, these are pretty much just baskets. I'll use mutual funds to start this because it helps you understand ETFs and indexes a little bit more. So when you think of mutual fund, think of it like this. We like to use smoothies or fruits to explain this because it's more imaginative for a lot of people. So you can decide to simply have an apple, or you can decide you want to have an apple, a banana, an orange, watermelon, pineapple, pawpaw, and a bunch of other fruits. Now, rather than eating them individually, you choose to put them in a blender, blend it all up, and make a smoothie out of it with some milk. Yeah. And then when you do that, that is what mutual funds look like. It's so many things put together, and then they offer it to you per unit. So rather than one apple being a unit of apple, is then a glass of smoothie is a unit of something you're buying as an investment. And that's how it differs. So, and one apple can be Apple company, and one banana can be Microsoft company, and one orange can be Nvidia company. But instead of buying one of each of those things, when you get a smoothie, you're pretty much buying maybe an ETF, for example, that has all these three companies inside it. So we call them baskets. So for somebody who does not want to think so much about buying individual company stock, and this is where you keep asking questions like, which one should I buy? You might just choose to go buy an ETF that has all the companies you could possibly be interested in the same place. And you just buy, by buying one unit of ETF, you have all these companies in your portfolio. Mutual funds are similar like that, except that with ETFs and mutual funds, you buy ETFs on the stock market, but you buy mutual funds from asset management companies. Okay, so mutual funds also differ. There are equity mutual funds, which is you buying shares of companies. There are money market mutual funds, which is basically investments in money market instruments. So there's treasury bills, there are commercial papers, there are fixed deposits, there are government securities, other government securities inside it. So you might not just want to go buy treasury bills alone. If you buy a money market mutual fund, you are basically invested in so many things together. The good thing about mutual funds is that an asset manager handles it. So your job is really just to give them the money and move on with your life. With ETFs, you just go to the stock market and you buy it from there. That is also managed by fund managers. So different companies pretty much have their own different ETFs. There are a couple of videos on my YouTube channel. If you go to the investing playlist, I explained a bit more about stock investing, ETF investing, and money markets, mutual funds. You can get all these investments on different apps, and some apps have more, I guess. So depending on the country where you live in, you will definitely find an app or a website to get your investments. I'm going to quickly mention this before we move on from here. When it comes to stock investing, if you're going to ask next, okay, how am I making money from all of this stuff? So let's talk about that a little bit before we move on. With stock investing, you can make money two different ways. You can make money from dividends, or you can make money from capital appreciation. I did tell you that stock is ownership. So when it comes to dividend, it's more like you give a company money to run operations. They make a profit at the end of the year, and then they take a bit of that profit and they share it among the people who have offered so generously to give them money as owners of the company. So your dividend is a reward for actually owning shares. Not all companies pay dividends. Some do, some don't. The other kind of companies may be companies that offer you capital appreciation. So in this case, you might buy a share for £100 today. Okay, £50 each. Let's say you buy 2 shares of a company. I'm going to use Apple because we all know Apple, for example. Let's assume 1 unit of Apple share is £50. It's not. And then you buy 2 units of it. And so maybe by this time next year, 1 unit of Apple share now costs £70. You still own 2 units of shares by this time next year, but your money is no longer just £100. It's now £140. That is appreciation in capital. They did not pay you a dividend, but just simply by holding the shares of this company, you suddenly have more money because the market is giving more value to that company. So this is capital appreciation. There are some companies that offer you capital appreciation and dividends. Apple, by the way, is one of them. Microsoft is another. But not all companies do that. Some companies just pay dividends, but their capital don't appreciate at a high rate. For example, Coca-Cola. It's a blue chip company. It's existed for such a long time. They pay decent dividends, but share prices do not go up as much as possible. So when I told you earlier to define your investment goals, if, for example, one of your investment goals was passive income, investing in dividend shares would be a good way to get passive income. If your goal is that you want to build wealth quickly over the long term, then investing in companies that will give you decent capital appreciation may be a good step to take. For example, Tesla. Tesla will not pay you dividend, but you do have opportunities to have your capital appreciate because of the value the market places on that company and how then their shares get priced over time. When it comes to bonds, you're going to get interest. So depending on how long or what the company or the government offers for the bond it puts out to the public, they will hold your money for a fixed period of time. And then at the end of that period, you'll get back your capital. They may offer to pay you interest over certain durations of the bond. For example, if you have a 2-year bond, they might decide we're going to pay you interest maybe twice a year or maybe once a year. So those durations is when you will get the interest from that investment. And at the maturity date, if it's a 2-year bond, at the end of 2 years, then you will get your full capital investment back. And when it comes to ETFs may give you dividend payments. Some of them may give you capital appreciation because they're on the stock market. They pretty much follow the same direction as what the stock market will do with individual stocks. Mutual funds will pay you interest over time. So this is how you make money from investing in these different asset classes. Treasury bills, by the way, is not listed here, but it is a government security and it's really more short term. So the government will offer treasury bills, but give it to you for pretty much like 30 to a 90-day period. So if you are looking to invest for a short period of time, within a month to 3 months, then treasury bills might be a good place for you to put your money into. So let us link this together, risk versus reward and the investment opportunities you have in each area. We start with low risk. When it comes to low risk investments, your rewards are potentially low. It's not always the case. For example, if you're investing in low risk investments in Nigeria currently, your rewards are quite high. And that's why we use the word potentially, because typically they're typically low, but sometimes you might get some extraordinary event like what Nigeria is doing and you get high reward. Volatility is low. This means that there aren't up and downs in that investment. And so most times your principal is safe. That means your invested amount is not eroded. You don't lose it. If you put in 20,000 Naira, you will get back the 20,000 Naira plus some interest. An example of investments that fall into this category are money market mutual funds, treasury bills, and government bonds. The next is medium risk. You get stable returns and some capital appreciation. You may lose your capital, and in some cases you may not, but this is a bit dicey. An example of this would be real estate. I know people say invest money in real estate all the time, but it can be quite tricky to put money in real estate because you might not be able to sell it when you want to. If it's a landed property, for example, the government can decide, well, we want to reclaim this land. There are all sorts of risks involved in real estate. So it's really important to pay attention to what you're putting your money into, learn a bit more about it before you part with your money. Another example is corporate bonds. I told you that government bonds are typically low risk. Why corporate bond is medium risk is because that bond is also dependent on the risk profile of the company itself. A larger, well-known blue chip company, for example, they have better bond ratings. And this means that they are more credit-worthy than some other companies. So if you put your money with a more credit-worthy company, chances are that you may get back your capital and your invested amount and the interest they will pay you. But if you put your money with some company that is not very credit worthy, they will likely offer you more interest because of their personal risk profile as a company. But like I said, it's 50-50. You may get your money back, but if they default, then you're not getting your money back. And then there are ETFs. ETFs come in different types, but depending on the type you choose, it might be medium risk, and in some cases, it might be high risk. But they are more lower risk than what you get with, for example, individual stocks in the stock market. And so finally, they are high risk investments. These have the potential of giving you high rewards. So with these investments, your capital is definitely at risk. You've probably seen maybe when you're trying to invest in cryptocurrency, before you buy, you see this caveat that just pops up and say, invested amounts may be lost or your capital is at risk. This is what it means, that the invested amount you put into that investment, you may completely lose it, or you may lose some of it. That the thing that is enticing you to invest there, which is the potential for good rewards, you just might not get it. Might is the operative word here, by the way. So an example is the stock markets. There is stocks, there's crypto, there are commodities, and there is Forex. There's so much hype about crypto and Forex. You need to understand that they are high risk. And this is why many people lose money there, is because they don't generally understand how it works. They don't understand the risk involved in investing in them. And so they end up losing money due to that ignorance. But thankfully, if you are here today, that ignorance is gone. All right. I should mention again that there is a link at the top of the chat where you can ask questions. I may miss them in the chat, so please use that link and put all your questions in there. It's a Slido link. And at the end of this class, I'm going to take those questions and answer as many as possible. So if you're a beginner in investing, there are a few options I can suggest that you start with, especially if you're also risk averse, which means you don't really want to lose your capital or you're afraid to lose the invested amount. So some good spots to start from would be government securities. So put your money in treasury bills, in government bonds, look at money market mutual funds, specifically money market mutual funds. There are also investments that are halal friendly. I want you to pay attention though to that. I cannot really put them in low, medium, or high because it depends on what investment it is. So you want to, as long as if your halal friendly investments fall into some of the categories I've mentioned, then you have an idea of what the risk profile is going to be. So you also have index funds and ETFs. Not all ETFs, by the way. So if you invest in ETFs that track index funds like the S&P 500, which is a US-based index fund, what it tracks is the top 500, the 500 largest company in the US, in the US market. So if you pay attention to those, you are less likely to lose all your money than you are to keep them. Why these options are good is that they're already diversified. They give you access to multiple investments in multiple sectors. The fees are low. Investments typically come with fees, so they're not like they're free to invest in everything. You pay a little percentage depending on what option you choose, and they offer you opportunities for long-term growth in your investments. So let's go back to our workbook. Section 4. You have a checkbox with some of the investment options I just talked about now. So I want you to tick the ones you are open to exploring today after this class. What do you think you're interested in? If you've never invested in the stock market, are you, for example, interested in going into the stock investing? Are you going to look at bonds, whether it's corporate bonds or government bonds, commercial papers? I didn't mention commercial papers earlier, but they would fall under medium risk because most times they come from corporates too. Index funds, ETFs, real estate, treasury bills, or if there's something that I haven't mentioned here that you think you might want to explore, you should definitely put that in others. If you're looking at investment, you can start with a small amount. Then you can do that. So many apps these days give you buy small option in quotes. So it's, for example, ETFs and stocks. You can buy tiny fractions of ETFs and stocks. If you're investing, for example, in the US markets, you can buy as low as $10 to $20 in ETF or stocks. If you are investing in, for example, the money market mutual funds, so many asset managers give you access to buy for as low as 5,000 naira. I think some even do 1,000 naira. So when you just take a look, you see what your minimum investment amount is going to be, and you can start from there. You don't need to have a lot of money to start investing, not in these times. There's so much access to investments and financial opportunities that just makes the barrier to entry really low. So pretty much anybody can get into the market and start investing today. It wasn't this way a decade ago, but so much has changed, and it's something very admirable and what I love about today's current financial climate. All right, so hopefully you're done picking the investments that you are interested in. I am personally interested in real estate now because I think I already invest in everything else on this list at different points in time, not concurrently, but real estate is something I haven't given a lot of attention to, and I would love to do some of that. So how do you start investing? It's one thing to learn that investing is something that's accessible to you. It's another to know, well, where to begin from. So first of all, choose a platform. You don't need to get a specific broker in some asset management company anymore. You can download an app and you can start. Different countries, depending on where you live, you have different app options. All right, so pick one. I will advise that you make sure that the one you pick is actually run by a company that is regulated. So investments are typically is a touchy space for a lot of governments because so many people lose money in scam investments. So you want to make sure that your platform, depending on the country where you're coming from, there is usually a financial authority that is responsible for this. Find out who that authority is and make sure that whatever platform you are investing in or through is regulated by that financial authority. So whether it's SEC, whether it's the FCA or the FSCS or SEC in your country or whoever, just make sure there's a regulation covering it. What this helps you is give you some level of comfort that even if something goes wrong with that platform, there's often sometimes some insurance that is provided that up to a certain amount of money, that if this platform goes bust, you should at least have access to getting some of your money back. And because they're highly regulated, there's always like some stuff they're expected to do maybe annually or biannually that just helps the authority check that these companies are still fit to hold customers or money from the public. So you want to pay attention to that. So once you've picked your platform, open an account, set a goal for your investing. I told you time is very important for investing earlier. So you want to make sure that when it comes to time, that you have an amount you are able to consistently put into that investment. This is how compounding is going to work for your benefits. Make sure you're feeding that asset regularly. Feed back the asset, feed back the interest. Unless your goal is to make passive income, then you can take back your interest and put it back into the investment. Allow that interest also make its own money. But if your goal is passive income, then sure, by all means, you can take your interest and do it at what you want to. But most importantly, stay consistent. Don't invest today, disappear for the next 2 years, and then show up again when you feel like it. You're not doing yourself a favor if you're not putting in money regularly in that investment. So there are different strategies you can use for investing. One is cost averaging. We say dollar cost averaging most times because, well, the US, and also because depending on the country you are in the world, you might be investing in the US market. So it's one of the largest stock markets, the New York Stock Exchange. And so many big companies in the world are actually American companies. So if you want to make the most bang for your money, then I think you should give that market some attention. I mean, forget what's happening now, but most of the popular brands, are actually there. So that market does mint money for so many people. But pay attention to it, but also pay attention to your local stock market too, by the way, because we also want to build other economies. So dollar cost averaging is, I told you before that rather than thinking of, oh, when should I buy and when should I sell? I've told you to do it consistently. So consistency in this case would mean pick your particular amount and regularly feed that investment with that amount. For you, it might be that you want to start investing maybe 5,000 Naira every month. Irrespective of the price of that investment, irrespective of the interest rate it is at today, take your 5,000 and put it in. And just keep doing that regularly over time. And this is important because I remember when I began investing in money market mutual fund, honestly, I was touch and go. I'll do it this month, I'll forget about it, I'll eat my money the next month, I'll come back 5 months later, I'll put another small money inside. Remember, there was a period when that market had about 3% interest rate because the economy was just really bad. And then, so I stopped. And then I wrote to the company and I said, oh, look, your investment is giving me just 3%. It doesn't seem like it's worth my time. This was like over 10 years ago, by the way. And then I remember the person responded and he said, well, it's low now, but it could be high tomorrow. And I thought, yeah, whatever. And I stopped. And then eventually it did go up to like 9% at some point. And I think that imagine I had stayed putting money into it and allowing compounding work. Yeah, sure, it was 3% then, but 3% consistently put into that investment would have left me at a better place today than the fact that I just stopped and waited for the interest rate to go up. So when it comes to investing, dollar cost average, don't worry about price. Maybe you invest in Microsoft shares today and you put your goal is just to put in 50K every month or 20K every month. Some months your share price will be high, which means you have less that you're buying. Some months it will be low, which means you have more that you're buying. But over the long period of time, your price will average. So you're buying high sometimes, you're buying low sometimes. There'll be an average price at the end of the period. And honestly, you'll be better than the person who keeps waiting for it to be a certain amount before they get in. So dollar cost average. Investment strategy 2 is to buy and hold. It still follows from what I've said before. Stop jumping in and out. You're not you're not a grasshopper. Stay put. If you stay put, you will reap the reward of staying put. So unless that investment is no longer doing what you were expecting it to do, maybe you bought your investment for a specific goal you had in mind. Unless you've met that goal, why are you jumping in and out? And just relax and trust the process. All right, so buy and hold rather than timing and leaving all the time. And 3, automation is your friend. One way to stay consistent is to not think about this. So set how much you want to go into that account, into that investment. So when your income comes in, the automation does its work. It moves the money out. The money you're not seeing in your account is money you're unlikely to spend on something different. So set up automations for yourself. So back to your workbook, section 5. You just have 1 minute for this, all right? Choose your investment strategy. So what's going to be your preferred approach? It can be all 3. And even if you're not sure currently, you can pick, I'm not sure yet. It's fine. Actually, you have just 30 seconds to do this. 1 minute is too long. Are you going to dollar cost average? Are you going to buy and hold? Are you going to automate your investments? You're not sure what you're going to do, or are you going to do all 3? I would personally love for you to do all 3. If you can, do it. Or pick one and start there and make a plan to pick a second one in the next 3 months. So before this year is over, you'd be doing all 3 comfortably, all right? I am going to reshare the link for asking your questions, even though it's pinned to the top of this chat. Go to the top of the chat, please. The pinned comment there is a link to ask your questions. So please put your questions in that link and I will pick it up and respond to all of them at the end of this class. So would you share in this chat with me what your strategy is? Are you going to dollar cost average? What are you going to do? Share with me in the chat, okay? All right, so small steps, big win. Go to section 6 now of your workbook. What I want you to write there is what your next steps would be for the next 30 days. This is the end of the month for May and June starts. So this is your goal for June. What are you going to do in June after this workshop? What are your next steps? If you don't have an account, are you going to open one? Because the point of knowledge is that you can take action. And I want you to be able to take that action. So what are you going to do next? Are you going to find one app and explore it? Are you going to finally sign into that account and tell yourself, well, today I'm going to make my first investment. Pick a low risk investment option and put your money in there. And just start from low risk, where your capital is safe. You know you can get it back. At the end of the period, you get your capital back, get your interest back. Feel good and proud of yourself and try it again the next month. Are you going to automate a monthly amount that you can invest? Are you going to decide every month, this amount of money is for my goals? It's me paying myself. I'm going to pay myself for my future. I'm going to honor the goals I have set in this class. I'm going to do something about accomplishing those goals. Put that there. Or are you going to research an investment option? Maybe you want to finally get into ETFs. More detailed video is on this channel. Please visit that and watch it in full. I also have demos where I explain to you how to buy and how to research ETFs. So maybe you want to research one ETF. You've heard about the S&P 500 for so long, and you're like, okay, now I really want to know what this is. What are you going to do in the next 30 days? I'm going to give you 1 more minute to write that. There are 3 steps for you, so you can fill all 3 or you can pick just one and do it. And then you can share with me in the comment section what that is for you. So just small steps. You don't need to do something gigantic. You don't need to be perfect. You just need to be willing to start. If you've been afraid for so long of investing, you need to say, today's the day that fear goes away. I understand risk today, and I know that it's possible for me to actually make good money without losing my money. When next you hear a random investment that you're like, oh, you're going to get 50% in 3 months, your brain just thinks immediately, yep, that's definitely high risk. That means I might lose my capital. Am I willing to take this risk? Is this platform regulated? Is somebody managing what's happening there? You stop being moved by the promise of a reward, and you start thinking strategically and critically about the opportunities available to you in the market. And if they are real or if they are fake. If they are fake, you already know to step away from it. And if they are real, you now ask important questions. Who is regulating this? Who is in charge of this? When will I get my money back? How much are you looking to give to me? When will this money come, etc.? So many questions and answers that you can actually research and find out more information about. So that's section 6 of your workbook. Hopefully you should be wrapping up filling out that section. I'm going to give you 1 more minute to do that because this is your action step and your action plan. And it's so important that you are able to crystallize what you're going to do next in 30 days and actually do it. You've obviously received your income for the month, so this is a good time to budget where that money is going to. If you've asked your questions on Slido, I am going to take them shortly and start responding to those in a bit. But before we go there, I want to talk to you about this thing I have put together for you based on every questions you have asked and the form I gave you to fill. Over 6 months ago, a lot of you said you wanted to learn more about investing, more about budgeting, more about saving, etc. What I've done here is to take all of that together and have created a toolkit for your money. This is something that will support you in your financial growth, in your financial journey to freedom. I have put in information about investing. Everything we've talked about in this workshop is in there in a bit more detail. No fluff, just straight to the point. People have asked, oh, what apps can I use? How do I know this app is fine? Is this app okay? What I've done is to do the research for you to pick out the apps that are quite useful for the different risk profiles and the different investment opportunities available. And I've listed them, all of them for you, whether you're in Nigeria, in the UK, in the US, wherever you are, in Canada. And even if your country isn't there, I have put some for you, a way that you can actually find out what's useful for your country too. So it takes away the thinking from the process for you. I've asked you to figure out how much you can put aside for investing because consistency matters. What I have done also for you in this toolkit is to walk you through a step-by-step process for doing that. There are workbooks for you to plan your finances, for you to budget. I know some of you have already gotten your workbook. So if you have, please say hi in the chat. Don't be shy. Let others know about it so they can also get theirs. There's so much packed into this workbook, into this toolkit, and it's called the Smart Money Kit. It is a financial system, basically. It's reusable, it's practical, it is so useful. I've used it for 12 years, and I thought to myself, well, rather than just simply doing these classes regularly, there's only so much you can learn in a 60-minute workshop. What I want for you to have is something that you can use all over and over again whatever level or stage you are in your financial journey or your financial journey to clarity, there is something in there that will help you. And I haven't just thrown information together. I've also created a roadmap, a step-by-step process for you to make the most out of this workbook. And of course, there's constant access to me. So when you get your toolkit, you're going to see how to reach me. If you have any questions or you need further support, you can always write to me. And I'm always happy to hear back from you and guide you in your journey. What I really want to do, one of the missions and goals that I have, which is part reason why I'm hosting these classes and putting this toolkit together, is that I want you to be supported in your financial journey. Not just telling you how to do stuff, but helping you understand why you're doing it and showing you how to do it. People come back and say, oh, I watched so and so video, but well, how do I start? This toolkit shows you how to start. And there's so much educational content too inside it that will support you in your journey. I've also added 2 bonuses for you to deal with your mindset. And for those who need to get passive income, there are digital product ideas, 500 of them, but they're not randomly created. They are intersections. So whatever your skill set is, you will find an idea for you to build on, market your skill to the public, and then make more money from your knowledge. There is a link to purchase the package. Can you help me reshare the link, please? It's in the chat. I'm going to post it for you. The current market value for this kit is honestly over £50. I have looked at so much eyes in the market and I thought, okay, this just handles one aspect. This just handles one aspect. So many tools out there are really about, just do this, do this, do this. But what I want to achieve here is 1, deal with your mindset. 2, give you a knowledge base. 3, help you crystallize how you want to do stuff because really personal finance is about you, not about what people say you should do. So it's going to guide you through understanding your goals and your needs, and then taking this knowledge that I've also provided and channeling it to your goals so that you're actually achieving things that are meaningful to you. Your money is going to what is meaningful to you. The value of this kit is over £50, but you're going to get it for just £19 and 14,000 naira. Yes, when you convert £19 to naira, it's definitely more than 14K, but my goal is not just to make, I'm not really thinking much about how much you're going to make. I just want you to get access to something that will help you. And so you can stop listening to the overwhelming voices out there, Googling nonstop good financial advice or how to make money or how to budget. Everything you need is in this toolkit. So just grab it and start using it. You've already been paid a salary. You can start with an intentional spending plan and make your actual budget that is realistic. And then start using that to work on your spending, on your investing, etc. I know this is going to be so useful to you. I know it with all my heart. So please do yourself a favor, invest in your future, and take charge of your money today. The link is currently in the chat, so please go grab yours. You're actually going to have this price for a very limited time. So please go grab yours now. All right, so this is 7:10. I did promise that we'll spend about 20 minutes responding to questions. So I'm going to go to Slido now and see what you have asked. Okay. Let's see. Okay, so I have a few questions here. If there are any questions you have in Slido, the link is pinned to the chat. Please use that and ask any further questions. If you see a question there that you like, just thumbs up so I can pick it up quickly. So Ruben says, hi, coach. I love that title. Thank you for always sharing valuable insights. This question is slightly off topic. But how do you manage your time effectively on a daily basis? Well, this is not very investing related, but I'll quickly say that one thing I found to be most useful is creating a to-do list. My mind can be a bit sometimes, especially when I have a deadline in place. Like honestly, creating this toolkit was such a giant deadline in my mind. I was sleeping and waking up to it. But write a to-do list. First of all, pick out the one thing that is most important for you to accomplish. Like if you do this one thing, you feel like you've had a very productive day. Then pick out two things that you need to also do that is equally important, but not as high priority as the first one. And then pick out three extra things that, if you get to them, good, but if you don't, it's fine. And then focus on just doing the things on, first of all, the one most important thing. When you've accomplished that, go to the next two and do that too. So a to-do list is important. And one thing is that when you just see yourself checking off items off a list, it does something to your mind. Progress births progress. When you see that you've done well in one area and you can see, oh, okay, I did good here, you're more likely to feel like doing the next item on your list and getting something productive there. There are other techniques like using the Pomodoro. You can Google Pomodoro technique. There's a 5, 4, 3, 2, 1, which is just, if you're feeling lethargic about doing stuff, just pushes you to go. Once you count 5, 4, 3, 2, you get to one, you get up and you go do that stuff and move on from it. But to-do list definitely has helped me so much in accomplishing much more. And that helps, Ruben. And Ruben, thank you so much for purchasing your kits. I love that for you. Do let me know how it's going. Someone says, hi, coach. Hi, Anonymous. I'd love to know how and what secure platforms a beginner investor can use for a diverse investment portfolio and also utilize index funds. I'm going to drop in a shameless marketing plug. Guy, get the kit. Please get the kit. Yeah, so depending on the country you are in, I'm sorry, I'll come back to your question. Akimuda, depending on the country you are in, it adjusts for your exchange rate. So if you're getting dollars, then you're definitely likely in a country where it's dollar denominated. The equivalent is still the 19 pounds I talked about. So you are still getting a gigantic discount off from the actual market value. So please grab your kits regardless. Thank you so much. Yeah, so secure platforms for beginner investors. Like I mentioned, the kit actually talks about the secure platform. It gives you actual examples of which ones to use per country. But I don't know what country you are writing from. That's the thing. But if you're in Nigeria, one of my favorites is iInvest. You get access to stock investing, commercial papers, treasury bills, and whatnot. There are all sorts of things there. It's unlikely that you will get one platform that has everything in it, but it's a good start. And I've used iInvest for such a long time that it did find it helpful for me. That's assuming you're in Nigeria, by the way. But for other countries, there are other options. So worth exploring. And please, again, get the kit. I answer all these questions in the kit. Please get the kit. It is an investment in your life, in your future. And you don't have to keep asking so many of these questions because I already answered all of them in a simple way for you with a few advices and recommendations to maximize your outputs and your wealth building. Okay, so someone asked, I don't have access to, okay, it's a security problem. Yeah, we dealt with that in the class. So someone says, what are your thoughts on building wealth through the sovereign sukuk? So if it says sovereign sukuk, then I think it's fine because it means it's very government related. So yeah, I don't have any reservations about using the sovereign sukuk. I think it's a good idea. I would do it if I was in Nigeria. I'm not, but I still do run Nigerian investments, but I think it's safe enough for you to step into it if you want to. But pay attention to the time frame that it's going to run for so that you're sure that this is how much you actually want to stay, how long you want to stay invested in based on the goals you've actually written for yourself in your workbook. How much can someone invest on ETFs for a start? I responded to this in the class, but you can start with as low as, honestly, $20 to invest in ETFs. It's the stock market, and it lets you purchase investments in fractions. So an ETF might be worth, a particular ETF you choose might be worth $300, but if the minimum investment amount for that platform is, for example, $20, you can actually buy just $20 of that ETF, and it gives you a fraction of it to own. So fractional investing is such a thing now, and we can do that by investing in the US market. You don't do fractional investing in the Nigerian market, by the way. If you're going to invest in Nigerian stocks, then you need to buy full whole stocks, like buy a full unit of the stock, not a fraction of a unit. But that shouldn't be hard because most of the shares in Nigeria are quite low. I mean, with 1,000 naira, you can actually buy up to, Zenith Bank shares about 54 naira. Divide 1,000 naira by that, and you can actually buy 1,000 naira worth of some shares in Nigeria. So that works. But yeah, for your question, about $20 is enough to start. Okay, buy and hold is such a great strategy for me. Investment is always a long-term mindset for me. Lovely. That is so good to know. But I want to also remember that I mentioned in class today that your investment goals might not necessarily be always long-term. So if you have an emergency fund goal, for example, that might not necessarily be like 20 years long-term. Or if you have an education goal, for example, too, it might want to happen for you in the short term. So pay attention to how long you want to stay invested. And then look at what risk your investments option is for the period of time you want to stay invested. Kindly review the buy and hold because it sounds familiar, similar to the dollar cost averaging, or is it buying a lump sum? No, not necessarily buying a lump sum. You can buy in fractions. So buy and hold is dollar cost averaging is the buy small over a period of time forever if you want to. Buy and hold is that even after you bought your buy small, you don't sell it. You still hold it and you keep buying. So yeah, they are related, but they're not the same thing. You can buy small and buy it for just 5 months and sell. Or you can buy small and keep doing that for 10 years. That's buy and hold because you're not just selling in the short term. You're holding it for a longer period of time. All right. So that's the difference between both of them. Hope that helps. Okay. Next question. If I have like $500, how can I spread this and start investing? I did tell you to mark out your goals at the beginning, and I told you to write about 3 goals. So if you have those 3 goals, some of them might be more short-term than others. That is a good place to start. You can spread your $500. If you have short-term, medium-term, I'm going to assume if you have 1 short-term goal, 1 medium-term goal, and 1 long-term goal, you can do the short-term goal with the low-risk investment options I mentioned. And so put some of the money in the low risk. If you have a long-term goal, then put some of the money for the long-term goal in maybe medium, high risk, maybe some low risk, depending on your risk profile, which is why you took the exercise about deciding your risk profile earlier on. So yes, you can spread, but make sure your spread is aligned with your financial goals. And if your entire goal is just completely long-term, then yeah, sure, do you. But definitely you can spread this to start investing. For example, if this was me, based on the goals I have, because I have buying a house, for example, as one of my goals, I could put maybe, that seems to be a very important goal for me. So I would personally choose to put maybe 50% of this in my housing fund goal. And I would use a low to medium risk asset because I have a 5-year goal for that money. Then I have retirement as a goal. And retirement is more 20 to 30 years away for me. So I can put like maybe another 50% in the retirement goal, or I could put 25% in the retirement goal. Because by the time I'm done with my 5-year period goal, the money I'm spreading for the house, I can then take that money, that's 50% for me, $250, and put it in my next goal, all right? And then the remaining 25% of this amount, I have maybe a medium-term goal of, let's assume I wanted to go further my education in the next, 5 to 7 years. I could also put 25% in another low to medium risk investment for that period. The reason I'm not using high risk for the shorter term goals is because those investments in high risk are they go up and down a lot. They're quite volatile most times, especially if it's in the stock market or in crypto. And I need time to even out that money for me. And that might not happen. I don't know because I don't know the future. Nobody does. But it might not happen in 5 to 7 years. And so if I take my housing money and put in something high risk like the stock market, if when I need the money, the market is at its low, it means my capital is pretty much unavailable at that point, and then I can't buy that house anymore in 5 years. So I would pick a lower risk investment opportunity for that because I want to make sure that capital is safe in the short term so that when I need the money, I can get it. So your options for spread should depend on your goals and the time frame available for those goals, which would then involve how much risk you should be willing to take in your investment approach. I hope that was clear and you understand it. Next question. Oh, wow. What are your thoughts on these? One, RSA as a leverage for someone with increased risk appetite, since they can still fall back on their pensions later on. I'm guessing that retirement savings accounts. I don't know what country you are in. So if you put a country, that would be quite useful in responding to your questions, because most countries have retirement savings accounts. But retirement savings accounts are very tax efficient, and that's something you should pay attention to. So while you're investing, for example, right now, depending on the country you're in, for whatever country you're in, take advantage of your tax efficient options first. Max them out as much as you can before you take general investment options. So in the UK, where I live currently, there are the ISAs. If I was going to invest in the stock market, I want to use up my ISA allowances. If you're in the US, you should be looking at your 401k and your Roth IRA, max them out. If you're in Nigeria, you have your retirement savings accounts already because those are linked to your salaried income, 8% and 10% contributions for yourself and for your employer. Something already goes in there. If it's possible for you to contribute more to it, then you should probably consider doing that. All right, before you then go into the regular stock investment apps, because those ones will get taxed at a higher rate than what your tax efficient options will give you. So max out tax efficient options first, and then go into your regular investing. That's what I recommend. But for somebody with increased risk appetite, whenever you put money in a retirement savings account fund, you get the options of choosing what investments you want them to go into. So always remember to do that. If you have increased risk appetite, then you can pick investment fund options that maximize your returns. So you have the option to do that. So, consider it. And so they can still fall back on their pensions later. So your pensions are not just magically put in low risk investments. They actually, you choose what investment you want to go into. Most fund managers may pick, if you're in Nigeria, they will pick something for you first based on your age bracket, and you can change it if you want to. But if you're in countries like maybe the US, I think you need to go pick something for yourself, because if you don't pick something, it doesn't really go anywhere. If you're in the UK, your fund manager will put it in something, but you should go check that what they put it in is actually what you want it to be. All right, Tony also asks, automating savings being seemingly cost efficient, e.g. it costs over 1K per transaction using credit cards to top up. First of all, I'm not sure why you're using credit cards to top up your savings rather than the money you actually have. But I'm not sure I completely understand this question though. Automating savings, yes, if you're automating savings, it is efficient. Okay, it said cost inefficient. It costs over 1K per transaction using credit cards to top up. So I don't know how it works for where you are, but if it is expensive to use that option to top up, then if you can promise yourself you'll be consistent with actually putting in the money manually, then you should definitely do that. Because automation is great, but you don't want to be losing money in the process of doing it. For example, I know in the UK, there's a particular app that if you use your card, it costs you money to use your card. But if you do a direct debit straight to your bank account, it's free. So explore the options available to you. But if you can be sure that every month you will manually go in there and invest, then sure, you can explore that too. Unrelated question. I have an ebook, but don't know how to put it out there for people to purchase. How do I go about this? Okay, this class is not about monetizing your knowledge, but I think it's going to likely be one of the classes that we hold later in the year. So if you're not signed up, you should be signed up to get my emails. It's in the description, by the way, of this video on YouTube. So definitely go there and register if you're not. If you just stumbled upon this, register, because I will address this in a future class. But I will say that you need to drum up awareness. And when you think about drumming up awareness, you need to get people's attention from whatever they're paying attention to. And one is to use social media platforms if you can. So I don't know what your ebook is about, but if it's about something that can help people in the problem that they currently have, then you want to talk a bit more about it online. You want to share your expertise, first of all, for free online. I'm not saying sell everything in your ebook for free, but give people something to make them realize that you're the kind of person who can solve this problem that they have, and then put your ebook out there for them to buy. Let them know, well, I've created this resource that is available and you can buy it. But first of all, the most important thing is awareness gets attention. Some of you are signed up to this class because you saw the link somewhere, or you know me from likely LinkedIn, or you've seen my video on YouTube, or you know me from Disturbing Your Life About Money on your WhatsApp channels and groups. So start from there, all right? Hi, Onyeka. I would like to get the recorded video for the course from the beginning. I joined at the end. It's fine. At the end of this class, it's going to be on my YouTube channel still. If you go on that live tab on my YouTube channel, you will find it there. So after this class, I will put it up there so you can watch from the very beginning. The workbook will also be in the description, so you can grab it there too. Thank you for your interest in starting from the beginning. Hi, Onyeka. Hi, back. Please, which bank or financial institution can I open an emergency fund account that I can withdraw easily in Nigeria? This is not financial advice. That should go without saying. Everything in this video is just for education purposes, guys. But back in Nigeria, I use VFD, V by VFD Bank app. It's a microfinance bank though, but I use them because their interest rates were quite good, and you can set up target savings accounts. And I found it very useful for setting up my emergency funds. So I think it's a decent place to start. iInvest also gives you savings options on their app with some decent interest rates. So, I mean, you can do that too. Interest rates are quite high currently. So, and what some people prefer to invest them in like money market mutual funds. Why I prefer savings accounts with high interests is that it's so easy to access them when you need to. So emergency happens, it's easier to withdraw your money than if you do it through your money market mutual fund. The withdrawal date might be maybe 5 days after you have made the request for payout. And that doesn't really help very much in emergency. It means you probably have to pull the money from somewhere else or borrow it until then they give you your money for you to pay back. So, but that is the way I do it personally. Please, may I pay the early bird fee next week, Catherine? Oh, hi, Catherine. Yes, you can. Yes, you can. I'm going to keep it up for you, just for your sake. I will keep it up at the current price it is, so you can pay. I'll hold it up for you to pay. Thank you for your interest. But yeah, you can definitely do that. So I just advise that you take the link and keep it where you will have access to it. I will still share it if you are signed up to my mailing list, so you can still access it. And those of you on this call feel like, oh, I need to make a little bit of plan to get this at the current price, then yeah, sure do. I'm all about people planning before they spend, but I really believe that the smart money kit to be very useful to you. So I really would advise and suggest that you actually get it. So much of what we've done today in the first class, this class, and the next class, and the one to come, actually already inside the kit. And it's very focused on, why, what, and how. And it's not just a one-time use thing. It's designed to be reusable, repeatable, practical. So just use it this year, and use it next year, and use it the year after that. And as your goals and your plans change, it fits around your new life, whatever that is for you. So please give yourself the investments of a better financial life and future. All right. Thank you for this teaching. God bless you for us. Thank you so much. God bless you too. Okay, so that is all the questions. Hopefully I got everything. Yes, definitely, Ruben. You should definitely rewatch it if and when you can. I suggest you do so. Thank you, everybody. So let's go back here. Section 7 of your workbook has something there for you, and it's really space for you to just reflect. So what I want you to do is to go back and revisit your why. It's so important. And that was the first thing you filled out here. Every time your reason for investing is going to change. So you need to go back to that reason. You need to check that it still aligns with what it is you want for your life. Life happens to all of us, and every time our plans may change. So go back and revisit what that plan is for you. Maybe do this every 6 months, reassess and realign and check where you are and adjust your investment to fit around your new reasons, so your new whys. Definitely take one step today. Fill that in and do try to do it. Keep yourself accountable, join communities and groups. And you know what? You can always write me. I send you emails all the time from my newsletter. So definitely respond to any of the mails if you feel like doing so, and just talk to me about what you're doing, okay? And I want you to remember that you don't need to know everything to start. What you've done today is a step in the right direction. You can revisit this video as often as you want to. It will be on the page, on the channel for you to rewatch, okay? And I would love for you to share this with other people. But most importantly, just start. Investment can feel daunting, but I promise you it's easy. You just need to start. And the more you do it, the more you're going to build that muscle over time. So everyone, thank you so very much for being a part of this class today. I have loved your energy in the chats, and thank you so much for purchasing the Smart Money Kits. Thank you so much for inviting your friends and for sharing the link and for honoring this time here today. I've loved your questions. Hopefully, you've gotten something valuable out of this workshop. I'm going to see you back here in about 2 to 3 months' time. I will share the link with you. Visit the description if you haven't signed up yet so that you can get the emails when the next classes are up. Thank you so much, everybody. This is with love, Onyeka from the UK, and see you next time. Bye.